CNBC TV 18, celebrating 15 years of leadership.
Good evening. Welcome to Markets Today. I'm Sonia Shenoy in the Mumbai studio, and from the Delhi News Center joining me is Surbhi Upadhyay. Surbhi, hi. Good evening. After the big carnage that we saw yesterday, today was not too much of a recovery. Actually, a choppy day of trade, and then by the end of trade, you still got an uncomfortable feeling.
That's right, Sonia. I guess that was a worrying point that some of the global markets were in a bit of a recovery mode, but here for us in India, well, didn't see that conviction. Let's quickly run through the top stories. A choppy day of trade following Tuesday's carnage. Markets end soft, failing to show any conviction. The Nifty ends at 8100 after losing about 0.3%. The Sensex holds just above 26,900. Banks, metal and IT stocks remain under pressure. Auto shares and oil and gas majors see some buying. HUL rallies 3% on brokerage upgrades.
All right, mid-caps outperform blue chips with the mid-cap index rising 0.3%. United Breweries surges almost 8% after CNBC TV 18 reports that Heineken may increase its stake in the company. Real estate and infra plays like Parshvanath, IVRCL, IRB Infra lose between 4 and 10%.
Even as oil continues to languish near multi-year lows, Citigroup says the bottom of the oil route isn't too far away. Expects a pickup in oil demand in the coming weeks. Meanwhile, Jeff Lewis of JP Morgan Asset Management Company says low oil prices don't necessarily signal weak global growth. They will, in fact, benefit the global economy.
All right, those are all the top headlines, and here are the experts that we have lined up for you on the show this evening. Market veterans Arvind Sanger, Ridham Desai and Anand Tandon will talk about the road ahead for the markets. Not just that, Sudarshan Sukhani, as always, will join in to talk about the technicals, and Seth Kleinman of Citigroup will give us his outlook for crude and global markets going ahead.
All right, so lots of opinion coming your way, but first up, let's start with the day's trading highlights. A volatile session on the Dalal Street after yesterday's carnage. There was a sharp decline in the last hour of trade, but some of those losses were paired off. Anuj is now here with the day's trading action. Anuj, what did you make of this, rather feeble comeback attempt after yesterday's mammoth decline?
Well, today was quite difficult actually because, if you see the intraday chart of the market, there were 4 or 5 occasions where the market tried to get into the green, and every time the market actually found selling right from the start up until the end. To be fair though, the Nifty managed to defend 8100 mark, though the conviction is missing as is indicated by the Bank Nifty. And even though the advance decline ratio was even and the mid-caps outperformed, it didn't really look convincing. But let's talk about some stocks then in today's trade. First, the losers, because it was a down day. So you had ICICI as the biggest drag, down 3%, ITC was down 2%, and Tata Motors 1.5% lower. On the other hand, contribution on the upside came from unexpected quarters, really. You had stocks like NTPC 2.5% higher, Lever for second day running was up 3.5%, and biggest contribution actually came from Reliance, that was up about 2%. Metal stocks had a weak day though, second day running, and that's one space which is quite clearly in a bit of a bear trend. So stocks like Hindalco, NMDC and Tata Steel were all lower in trade. Oil and gas, that's one space which has seen quite a bit of fall. Today was a bit of a mixed bag. ONGC saw some bargain buying, value buying, whatever you may want to call it, 1.5% higher, but the other two, KN and GAIL, were still lower, down about 2.5%. In the mid-cap side, there were some big winners today. A lot of high beta names did well. Suzlon was up 9%, Jubilant was up 10%, Ashok Leyland clearly has been the stock of this month so far, up about 5% in trade today. And on the mid-cap side, in terms of losers, you had some high beta names again. Parshvanath Developers down 13%, IRB down 4%, and PFC down 3.5%. So the day after was quite okay for the market. Let's see how the next few days pan out, because as of now, it looks like the market is still a bit nervous and still a bit weak.
Yes, indeed, nervous it was, Anuj. After that big slide yesterday, no recovery at all. In fact, second day running that there was a cut in the market, and by the time we ended just shy of that 8100 mark. But let's get you some market perspective, because 9 out of 10 people that we spoke to are not perturbed by the global fall. In fact, they believe that this is a good buying opportunity for the long-term investor. So here's a look at Arvind Sanger, managing partner at GEOSPHERE Capital. He strikes a slightly cautious note. He expects a further 5 to 7% correction. However, he believes that India is a good buying opportunity in the longer run. Ridham Desai of Morgan Stanley is not too worried about the correction at all either. Listen in.
It somewhat depends on how badly global markets respond and how the news out of Europe plays out. Because, in Europe you have the Greece news. You also have the expectation that the ECB will do some form of quantitative easing in the near future. There's a concern of Greek exit. Then, you could have that plus some hawkish details coming out of the Fed last meeting minutes that come out tomorrow. If you get a combination of those factors, you could get another 5-7% pullback in Nifty quite easily, and therefore you could, dip below 8,000. India is barely started its economic recovery in terms of earnings from the trough of the GDP growth and the earnings growth that we saw a couple of quarters ago. So I would say India is still in its early stages. Obviously, the stocks had a great run in 2014, so there's always room for pullbacks here. But I think in terms of India, India's medium to long-term story, we're still in the very early stages.
There's no reason to be spooked. I think it is not out of the ordinary that we get corrections along the way. We had a pretty much straight line market for 2014, so I think 15 is unlikely to be straight line. There will be more volatility, and I think what we are seeing right now is just one of those bouts of volatility. Globally, I think there will be these concerns that will emerge from time to time, and whenever the global trade moves from disinflation to deflation, it will hurt India. I don't think India's macro is past that point where the global picture will not matter. Right now, I think I would call it as a deflation scare or a flash deflation scare, is going to hurt in the short run. So these short-term corrections, I think, provide opportunities for investors with a longer duration, longer investment horizon to buy stocks. As we go later into the month of January, the market's focus will shift to the budget, and as usual, February is a good month for the market because the market builds up in anticipation of the budget. So it's unlikely to be different this time. So I think this correction will be forgotten by then, and we'll be anticipating a strong budget, and the market will respond accordingly.
All right, so the global correction could be forgotten soon, and market men are anticipating a strong budget. But now for all the action from the futures and options space, let's go across to Nigel D'Souza. Nigel.
That's right, Sonia. In fact, today we had a weak trading session. Just look at the VIX. The VIX shot up and traded. It was up close to around 4% odd. That tells you that, in fact, volatility is back in the system. Call writing is making you money. So even in today's trading session, that 8,400 level, that's the level where the Nifty has faced resistance numerous times. Today as well, it was fairly active. The premium, remember, is at around 40 bucks odd. But in the near term, that 8,200 to around 8,300, that's going to be a very, very firm resistance. Take a look at the 8,200 call in today's trading session. The premium's around 110 bucks. And that one was getting written, so the stop loss comes in closer towards that 8,300 level. The 8,300 put on the other side, we did see some put buying earlier in this particular series, and in fact that one is getting unwound now. So traders are pocketing around 210 rupees, taking a bit of a punt and buying some protection on the downside at around that 7,800 put. That premium today was at around 37 rupees. Take a look at the 8,000 put though. That's where the firm resistance for the Nifty lies. That's because the highest open interest on the put side is at around that 8,000 level. So in the near term, in fact, that becomes a key support area for the Nifty. Individual stocks that were in focus, Reliance Industries, in fact, popped up and traded. It did see a big short covering bounce, while NDPC as well did see a big short covering bounce in today's trade. The big problem for the Nifty, though, was that a couple of heavyweights, ICICI Bank as well as ITC, both of them were getting sold into at every jump up. Importantly, another stock is IRB Infra. Remember, the stock got shorted earlier in this week, and today as well, the stock was down close to around 4%. Big open interest build up. Big shorting being seen on that counter, but the mid-cap index had a relative outperformance, and that was really evident in the likes of LIC Housing Finance as well as Ashok Leyland, both of them ending at the high point of the day. Fresh longs being seen on both those two counters. Back to you.
All right, Nigel, thanks so much for that. Yes, as you said, it's never a good sign when you see blue chips meet selling pressure at every rise, as Nigel was explaining there. Well, markets have tried to stabilize after the sharp fall yesterday, but what will the next few days throw up? Mangalam Malu is now joining in with a lesson from history. He's been doing an analysis on the aftermath of the Nifty's fall in the past. Mangalam, what trends have you picked up?
Well, clearly the Nifty ended marginally flat today in the negative, but however, that's how it's been in the past as well in the next day. If we pull out the data for the next day, we will see that 6 times out of the last 10 days, Nifty has ended in the green, and 4 times it's ended negative with a range bound of +3 to -2.5. However, what's more interesting is if you go into the next 10 days, what happens is the quantum of profits increases and the quantum of losses decreases. I mean, although 6 times the market ends up in the green and 4 negative, but the quantum increases. That's interesting. However, what's more interesting is if you extend it to 10 months, that's where the real returns are to be found. In the next 10 months, you will see about 45, 32, an average return of 22%. In fact, with the highest returns being in the last recent fall in Nifty in September 2013. If you bought Nifty at that point and held on for about 10 months, you would make 45% returns. So this confirms the old adage that if you buy on dips and hold on for long term, you are likely to be in the green.
All right, very interesting data. Thanks for putting that together for us, Mangalam. So clearly, when the markets fall, there is opportunity in adversity that the investors find. But on to another CNBC TV 18 exclusive. Dutch beer giant Heineken wants to have a larger swig of United Breweries, it seems. CNBC TV 18 learns that Heineken has approached United Brewery lenders to directly buy stake from them. Kritika Saxena joins us with exclusive details. Kritika, what else are you picking up?
Well, at the risk of sounding corny, Heineken has been gradually taking larger sips of United Breweries Limited over the last 1 year. Now, the best option to do that, given the fact that the promoter shareholding is already at 75%, is to take in shares of lenders. Lenders have been selling their pledged shares that they have in collateral against the loan that had been given to Kingfisher Airlines. They have shares of United Breweries Limited as collateral. So they have been selling in the open market. Now, just to quickly help you understand the promoter shareholding right now, Heineken holds 39.01% and UB Group holds 35.81% in United Breweries Limited. Now, Heineken wants a larger control. They are already the larger shareholder, but they want a larger control over UBL, and that is why I understand from my sources that they are likely to ask the lenders directly for shares. The percentage depends on how much lenders are willing to sell, but I do understand that they are looking at hiking it up to at least 4 to 5% minimum. Again, it depends on how much lenders are willing to sell. 5.3 crore shares are pledged. That is how much lenders have currently, and that's around 53.88% of UB Group's shareholding. So there is a significant chunk that Heineken can grab in, and let's wait and watch out to see if lenders do agree or not. Heineken on its part says that they cannot comment on market speculation.
All right, Kritika, thanks so much for getting us that story. Let's now shift focus back to the global space. There seems to be absolutely no respite in sight for crude oil prices. Brent prices slipped to below $50 a barrel in early trade. That's the first time since May 2009 that prices have seen that level, and markets across the globe, of course, have been reacting to this. Let's now hear out some global voices on where they see the road headed.
People are still bearish on oil, but I think you need to remember, cast your mind back to 2008, 2009, when the world really did feel like it was coming to an end. And we briefly went below $40 in the oil market. I mean, do the oil markets now look as bad as they did then? No, they really don't. I mean, demand is doing okay. What has happened here is a supply story and a surprise move by OPEC where they kind of got out of the way. So we think that oil prices are in the process of finding a bottom down here.
So I think we are seeing signs of easing in the stress. We had a risk-off period in November also when investors were beginning to think maybe the plunge in oil prices was due to a weakening global economy. Our fundamental take is that this is incorrect, that lower oil prices are actually a net benefit to the global economy, which should become more apparent perhaps only after a couple of quarters, because there are lags before the effect of low oil prices moves through into consumer demand, investments, second-round effects, etc. So it's very good news, we think.
I think most of the equity markets might go through a tough time. And the reason being very simple, rising disinflationary pressures on a global basis. That's been building for at least the last 6 months, and it's clearly continuing into the first quarter of 2015. Now, emerging markets are on the cutting edge of that, but that applies, as I said, negative undertone applies to pretty much all equity markets globally.
All right, that's the view coming in on how to approach crude. We'll take a short break on markets today, but coming up, Sudarshan Sukhani joins in for a quick technical chat, and we'll also get you some trading ideas. Stay tuned.
CNBC TV 18, celebrating 15 years of leadership.